everyone. I'm Aaron Sachs. I'm a senior manager in our Hillsborough office and leader of our nonprofit team. I want to welcome you all to our rebroadcast presentation today, what every nonprofit needs to know about Form 990. Today, we'll be viewing an earlier presentation by members of our nonprofit group, Fritz Duncan and Edwina Kittlewin. And we'll be walking through the Form 990, sharing tips and best practices, and even use of the form as a marketing tool. But first, a little about Jones & Roth. Our firm has been serving clients in the Pacific Northwest for over 80 years. We have 3 offices across Oregon and a team of about 100 members. Our team is niche focused, which allows us to specialize in industries to serve our clients with the technical expertise of a large firm while providing the quality service you expect of a local firm. Our nonprofit group is one of the largest in the firm. We have a diverse team of CPAs and business advisors dedicated to serving our nonprofit clients. I'll be your host today, and I also like to introduce you to our presenters. Fritz Duncan is a partner and shareholder based out of our Eugene office. Fritz joined Jones & Roth in 1995 and leads both the nonprofit and affordable housing teams. Edwina Kittlewin is a manager based out of our Hillsborough office. She's also part of our nonprofit team and has been with us since 2017. So let's take a quick look at what we'll be covering today. We'll be discussing the layout of the Form 990, including key schedules. Next, we'll be diving into best practices for board review, what's required and what to watch out for. We'll then look at unrelated business income, identifying the activities that could create a tax liability for your nonprofit. And finally, we'll discuss how to get the most out of your Form 990 from a marketing perspective. Please feel free to submit your questions throughout the presentation. Be sure to use the question function in your screen for this, not the chat feature. We have a team member monitoring those questions, and we'll do our best to address them as they come in. If we don't get to your question, please feel free to reach out to us after the presentation. All right, without any further ado, let's get started on our presentation.
So first, an overview of the Form 990 and the key schedules. The core form is comprised of 12 pages and 12 parts. So part 1 is really just a summarization, a snapshot of your nonprofit organization and the information that's reported elsewhere. So it shows items like your mission statement, some categories of revenue and expenses, your total assets, total liabilities and total net assets, and that will show the current year and the prior year. Part 3 is where you display your mission statement and your program service accomplishments. So this is where you'll showcase what your organization accomplished throughout the year. Part 4 is the checklist of required schedules. So this is where you'll be reporting to the IRS on your organization's various activities. And the responses to these questions will usually drive what supporting schedules will need to be completed. Part 5 and Part 6 has tax compliance and governance questions. And then Part 7 is where you disclose compensation of officers, directors, and key employees. This is a major section where we typically get questions on, so we'll take a deeper look into what that entails. So Part 7, compensation of officers. So one important note is that this is completed as of a calendar year basis. So many nonprofits are on various fiscal years that don't end on 12/31, but this information should be completed as of the calendar year that falls within your organization's fiscal year. So who should be included in this section? That would be current officers, directors, trustees, key employees, the current top 5 highest compensated employees who have received compensation over $100,000, any former officers, key employees, and highest compensated employees that receive over $100,000 of compensation, and former directors and trustees that received over $10,000 of compensation. So for purposes of the Form 990, current would mean that that individual served in that role at any time during the tax year. For purposes of reporting former individuals in these roles, there is a 5-year look back period. So they would only be included if they were compensated in the current year, but not considered in a current position of one of those roles. So an example would be you had a board member that was part of your board in the prior year, but in the current year they weren't part of the board, but they may have provided consulting services. They were compensated over $10,000, so that would be disclosed in this section. Next, we'll go over definitions of these roles. So first, what is an officer for the Form 990? Those would be individuals designated as officers in the organization's bylaws. So that would typically be the president, the treasurer, or the secretary. Also, at a minimum, the organization's top management and top financial officials should be considered officers. One thing to note that this could be the same person. So for smaller organizations, this could be just the executive director that's filling in both of these roles.
Hey, Edwina?
Yeah.
Just to really add on to that, we get this question a lot. You know, for the executive director, they should always be on here. And then a lot of times the controller, the CFO will ask if they have to be on here. In most cases, the IRS is saying if you're the top financial official, you should be on here. But as Edwina said, there is some exception where maybe you can argue the executive director serves both those roles. But just in case you haven't heard that before, both those two key people, even if they're not an officer, should be listed because the IRS considers them an officer. There you go.
Right. Okay, moving on to the definition of a director or trustee. So this would be a member of the organization's governing body at any time during the tax year. So even if this individual was part of the board for just a few months, they would still be included here. An important note is that these individuals must have voting rights. So a member of an advisory board that doesn't exercise any governance authority over the organization is not considered a director or trustee for purposes of this section of the Form 990.
And Edwina, and just to add, we get this question a lot. If a board member is not on there at year end, should that be on here? And the instructions say yes. If they were a member during the year, then they should be listed even if they weren't a member at the end of the year.
Correct. Next is key employees. So for a key employee, they must meet 3 tests. First is the reportable compensation test. So this employee must have over $150,000 of compensation in the tax year. Second is the responsibility test. So does this individual have power to influence the organization as a whole? And finally, the top 20 test. They must be in the top 20 highest compensated employees. So there are various things to consider when reporting a key employee on the Form 990. While they might seem to be a key employee in other aspects of the organization, for the purposes of the section, they must meet these tests.
And then we get that question a lot on this one too, where they ask why their key employees not on the list, and it's generally because they're not over the 150. So you may have given us a list, you may have listed them on there, but if they're not over the 150s, then they don't go on that list.
Finally, we have the definition of a highest compensated employee. So this would be an employee other than the current officers, directors, trustees, or key employees whose aggregate reportable compensation from the organization and related organizations is over $100,000 for the calendar year. So for highest compensated employees, this would just be the top 5, and it's for compensation over $100,000, and if they don't fall into one of those other categories. Now that we've went over who is included, what is included in this section. So there are 3 columns. The first column would be reportable compensation from the organization. So this is generally the greater of box 1 or box 5 from the W-2, but this may include other items. The second column is reportable compensation from related organizations. This part may be easy to miss if it's not careful, but this usually comes up for supporting organizations. Lastly is other compensation. So this is where you would include things like non-taxable health insurance benefits, employee retirement contributions, and other non-taxable benefits.
And Weena, could I chime in really quick on the related organization?
Yes.
What we see often is for any of you that are foundations and that somebody else, a hospital, a college, university, somebody else is paying your staff's salary, it goes on here, and that confuses the nonprofit sometimes because they didn't pay them, but you're still supposed to disclose it. If that, you're the foundation executive director, the hospital's paying for your compensation, you're supposed to disclose it on that other column because it's compensation for the organization, even though the organization's not paying for it. Go ahead.
Great. So back to kind of the sections of the core form. So part 8 is the statement of revenues. So this is where revenue is reported by type and classifications. The two major sections that you would see revenue reported is contributions and program service revenues. There are some items that are reported net of expenses. So for example, fundraising events, those would be reported net of expenses. Part 9 is the statement of functional expenses. For 501c3 and 501c4 organizations, they must complete all columns, so breaking out the expenses between program management and fundraising, but for all other organizations, they only need to report the total expenses by natural category. So in addition to natural categories such as salaries, professional fees, office expenses, those organizations listed would have to break out how they're related to program management and fundraising. And this is a section that we'll talk about multiple times throughout our presentation today. And it's just important to be mindful of the allocations to general and admin versus programs. And we'll discuss some benchmarks to look out for during review of the Form 990.
And then Edwina, just to chime into that, so just be careful here. If you're not doing an audit or you're not preparing a statement of financial expenses, how you fill out this form, because people like to read this and judge you on your, and we're going to go over the percentages later, but they like to judge you on what you're putting in the management column, what you're putting in the fundraising column, and what those percentages are, and we'll talk about it later. But just be careful here if this isn't something you go calculate every single year, be careful on how you do it, because people read it and they like to calculate things and judge you on how efficient you are. And so you got to be really careful how you fill it out. Go ahead, Rita.
And then the last few sections of the core form are the balance sheet. So this is very similar to your statement of financial positions in your financial statements. Part 11 is the reconciliation of net assets. So there are some differences between GAAP financial statements and the 990, and so that's what those differences would be reconciled. Some common ones would be unrealized gains and losses and donated services. So while those might be included on your financial statements in the revenue, those are excluded for the Form 990. And lastly, part 12 is financial statement reporting information. So these are just questions whether your organization is on the cash or accrual basis, did your organization have a review or audit, and is your organization required to have a single audit?
And then really quickly, Edwina, we get this question also on those two schedules where someone will read your audit, they'll read your 990 and they don't match and they'll just assume something's wrong. These two schedules are very good at reconciling the audit to the tax return. So if they knew how to read these two schedules, they could go in and see, oh, here's the audit number, here's the tax return number, here's how it reconciles. I understand versus they don't match. There must be something, wrong. It must be a mistake. It's like Edwina said, there are differences between an audit and a tax return and how things are reported. Go ahead.
Great. Were there any questions that we wanted to address before moving on to the schedules?
No questions right now.
Okay, sounds good. So I will pass it over to Fritz to discuss Schedule A.
And then Rita, if you don't mind, can you bring up the Schedule A?
Yes, of course.
Walk through people with forms here. So Schedule A, this is one of the most important schedules on the 990, because what it's doing is that if you want to be a public charity, you have to meet this test, which we're going to walk through. You have to fill out this form. You have to meet the test. Otherwise, you're not a public charity. You would be a private charity or not a charity at all. And so you have to go through and fill out this form and meet the test. So the first part here is there are these key lines. One of them is 7. So line 7 is typical social service charity. Do I get a substantial part of my support from the government or the general public? And that's 33%. Show you that in a second. But that's one of the main tests. They're only counting support here. So charities that only need to count their actual donations fill out this, they meet this test. There's an optional one down below on line 10 where if you're a charity that has 33% from donations, program fees, membership fees, etc., you can count those fees to meet the test. There's some restrictions on that test you have to be careful of, but you can meet either one of these. We see most people meet the line 7, but some people do need line 10 to get their 33% to meet the test. There, you can see there's a bunch of lines on there. There's a lot of different types of nonprofits that can check these boxes to meet this test automatically. We don't run into a lot of those, but you can see the churches, there's some schools, hospitals, etc. Also, we're not going to go into box 12 there. If you are a supporting organization, there's a bunch of rules there. You could also meet it, filling that out. Pretty complicated, so we're not going to go through that right now. But if you need help in that area, there's a lot of good guidance on how you fill out these pages. Just want to flip the page there. So the first, so I said line 7. This goes to this is part 2. So the key parts are line 1. It's a 5-year test. You list all of your donations, etc., grants. You list them all there on line 1. There's a few things that go in there. But then the key there on line 5 is you don't get to count all your donations. If a large donor, which is somebody that's more than 2% of line 11, if they give you more than that amount, it gets excluded. And so then you have an adjusted public support. So that line 6 isn't total public support, it's adjusted. That number, and then less these other things down below, the line 8, 9, etc., they all add up to line 11 total support. Line 6 divided by line 11 has to be over 33% for you to meet this test to be a public supported entity. So the takeaway is line 5, I got to be careful of large donors. For line 5, the large donor is an individual or private foundation. So governments don't count, other nonprofits don't count. They don't count against you in line 5, but a large individual, a large foundation, private foundation, they go there and they get backed out. So for the people that get these large private foundations, they got to be a little bit careful that they may have had a donation, but since it's from one entity, it could get excluded, and then I'm not going to meet this test. So we see that where most people we see are in the 90%. The people that have some large donors, maybe they're in the 60%. If you start getting close to 33%, you need to be talking to your accountant about, I'm going to have an issue here, what can I do? You can see on line 17 there is a fact in circumstances for 10%, that's pretty rare. So just be aware of this test. I have to go through and calculate this for this 5 years every year. I have to be above 33% in general for me to still be a public charity. So that's the first test. And then the second test.
Before you get into part 3, we do have a question regarding the requirement to back out large donations. You said that all donations like foundations and things that are over a certain percentage, are there any amounts that you don't have to back out even if they're over that percentage, like from certain types of entities?
Yes, so in case I skipped over that, governmental entities and other nonprofits do not get backed out. So for example, Lane County gives you money, that doesn't get backed out, whereas the Ford Family Foundation, if they give you money, that does get backed out. So private foundations, individuals get backed out, governments, nonprofits do not. So most charities don't run into a problem here. We'll see some that have big private foundation grants or even some big donor grants that they potentially get an issue. So hopefully that answers the question. Anything else, Carrie, you think I should add to that?
Nope, that was helpful. Thank you.
Okay, so if you go to the next test, so the next test, the good part about it is line 2 and 3, the group gets to count donations and grants. They get to count program revenues under line 2 and 3, and maybe a few other things they get to add. So you get to count these other things, which might help you. But if you look at line 7 and A and 7B, there's also more that gets backed out. So 7A, the main thing that's backed out is disqualified people. The main thing a disqualified person is a board member, an officer, etc., a related party, they would get backed out. But if you look in the definition there, a large donor that gave you more than, I think it's 1%, exactly, if it's 1 or 2%, but there's some percent that they're giving you more than your total donations over the nonprofit's lifetime on 7A would get backed out. So if you had some consistent grant money coming in from a person that was a large amount and that over that amount, it gets excluded. Unfortunately, 7A, that's everybody. So if you had a large grantor, whether it's private or public, and they're giving you money consistently and they're more than this amount over your lifetime, on 7A they would get excluded. And then 7B is, if there's anybody in any given year that gives more than 1% of line 13, they would also get excluded. That's only line 2 and 3 though, so it doesn't count, donations don't count for that. But the takeaways for line 2 and 3 is, do I have large contracts that would run into a problem on 7A or 7B, or is it a bunch of individuals? Like if I have rent, if I have people I have contracts with, as long as they're not over some huge amount, it's not an issue. But we've seen people where they might have a consistent grantor that gives them money every year and they're over this threshold and it would get backed out. As long as they don't go below 33%, they're still okay. So that's the main part of part 3 is I get to count more revenue, some might get backed out. I still need to meet 33%. The last thing that we don't see there on section D very often is you also have to have limited investment income in these types of entities. Again, I don't see that a lot where people's investment income is above 33%. You could see if you're a foundation, maybe you'd run into that. You have to be careful that my investment income isn't higher than that allowable amount. So those are the 2 keys. If you meet either one of these, depending on which test you're meeting, you're a public charity, you have to meet. Okay, any questions on that? All right, Edwina's gonna go jump into the next couple of schedules.
Great. So the next schedule that we'll be talking about is Schedule B. So first, who must complete the schedule of contributors? So this is for organizations who receive contributions that meet certain filing thresholds, which we'll go over in a little bit. And so what gets reported? So only revenue that is classified as contributions, gifts, and grants that are reported on lines 1A through H of the statement of revenue are included on Schedule B. So if we take a look at the form here, in the statement of revenue, only the revenue that's included in these sections is what's being considered for Schedule B reporting. So a couple of things to note, that this includes cash and non-cash contributions, and this would not include program service revenue. Back to the slides. So for the reporting thresholds, there is a general rule and a special rule. So the general rule is that all contributions over $5,000 must be listed on Schedule B. However, there is a special rule that allows 501c3 organizations to use a higher threshold of 2% of total contribution revenue if they are meeting the public support test using Part 3 of Schedule A. So the second part that Fritz just went over in Schedule A, they must be using that section of that part and then meeting the public support test to be able to use a higher threshold of 2% of total contribution revenue. And your CPA will typically advise you on what needs to be completed, but that's how the general rule and the special rule work. And then another thing to note is that for Schedule B, these are totals by donor. So if a donor made multiple donations during the year, but the total of their donations is over whatever threshold is being used, the total of that donations is what would be reported. Lastly, for contributor privacy considerations, only 501c3 organizations are required to report the names and addresses of their contributors on Schedule B. Other types of organizations aren't required to include it on the Form 990, but they are required to retain records for that information. And then the names and addresses only go to the IRS. The public copy does not include donor names and addresses. So sometimes there are donors who are worried about the disclosure of their donation, but it's only for the IRS as that information is disclosed, and it's not included on the public copy.
And then, Amina, can I just add on to that? We always get this concern about that as well. And you make a public copy, there's another copy you make that doesn't list the names, and then you electronically transmit your 990 information to the IRS has the people's names, but it doesn't go anywhere else. So in case people ask, there's a public copy that goes out to everybody else, and then there's the IRS copy that goes directly to them. So you don't have those people's names floating around somewhere.
Great. The next schedule that we'll be talking about is Schedule D, Supplemental Financial Statements, and we'll go over a couple of sections for that. So let me pull up the example form. So Part 5 is where endowment funds are disclosed. So it will be showing 5 years of activity for the endowment fund. So the beginning of your balance, contributions, investment earnings, other expenditures, and the end of your balance. And this includes actual endowments and board designated or quasi endowments. And in line 2 is where you would disclose the percentage of the balance for each type. In line 3 is where you would disclose where the funds are held, if it's held by the organization or somewhere else or by a different organization. And then Part 4, or line 4, is where you would describe the intended use of the organization's endowment funds. The next section of Schedule D that we'll go over is Part 11 and 12, which is the reconciliation to audited financial statements. So as we mentioned earlier in the core form, there is a reconciliation to net assets. But if the organization has audited financial statements, then they're also required to complete this section to reconcile total revenue and total expenses. If we go over to the form, that is this section here. So some common differences would be net unrealized gains and losses on investments, donated services and use of facilities. So while those would be included in revenue on the audited financial statements, those would be excluded in revenue for the Form 990. And similar with expenses, donated services and use of facilities would be included in expenses for the audited financial statements, but not included for the Form 990.
And then can I chime on there and read when you're done?
Yes, go ahead.
So again, just to reiterate this, donated services, use of facilities are usually big numbers. They're on your audit, not net unrealized gains and losses, usually a big number. It's on the audit, but it's not on the 990. Those are the two keys. And then again, if you don't know how this form works, is you think the two things don't match, especially that 2B, donated services are sitting in your donation lines on your audit, but they're not here. And so you think your donations are off quite a bit, but they're not. It's because of no donated services or facilities are on the 990, but they are on the audit. So those are the 2A and 2B. Just be really careful of those, that you're aware that that is a difference. It could be a big number, and they go here, and then this reconciles the two. So you should be able to look at the audit, look at the tax return, and say, oh, I see how they match, and this is why. Go ahead.
Great. The next schedule that we'll be going over is Schedule G, which is fundraising or gaming activities. So Schedule G is required when gross receipts from fundraising events is more than 15,000%. Going back to the forms. Here is Schedule G for fundraising events. So for the events, if there is any event that has gross receipts of more than $5,000, those top 2 events would be reported here individually, and then the rest of the events would be combined in this other column here. It's important to note that contributions and gross would be broken out. So for example, if the event has a fee like a dinner, we would want to break out the amount that is considered the contribution and then the amount that would be considered paying for the dinner. And then you'll see below here, there are certain categories of direct expenses that are broken out. So while the event is being held, it would be easy to track these different types of categories. So then when it's time to complete the Form 990, all that information is readily available to complete here. And then as mentioned, oh, go ahead.
No, go ahead.
As mentioned before, fundraising events are reported net on the statement of revenue. So this, the net amount here in this box is what would be reported on the statement of revenue. Go ahead, Fritz.
I was just going to add for the group, I think a takeaway from this is if you're having large events, if you don't mind setting an account for donations that you get at the event and don't lump it in with your gross receipts. Because for the most part, we need to back that out. Like Edwina said, it needs to be moved out of here and it gets put under your contributions line in the revenue schedule where this is just the special event line. So it's nice that people track the revenues by type in their special event so we can get them in the right spot. Right.
Okay, the other section of Schedule G is gaming. So this includes things like bingo, casino night, raffles, and it's really important to discuss these types of events with your CPA because these types of activities may require licensing depending on the state you're in. So you just want to be aware of those if you're holding an event that would fall under the gaming category.
Yeah, and then just to add on to that, just be careful, like Edwina said, the people that manage these departments for the state, there's penalties, there's, you know, they're pretty good about following up on things. So if you're going to do bingo or some other type of gaming, make sure you go research the rules, or you have to actually have a license to do bingo ahead of time and file a report every year. So there's all sorts of things outside the 990 you need to do if you're doing these things. So just think about it ahead of time before you get into it. That's always the best advice. Go ahead.
The next schedule we'll be going over is Schedule I, so grants or other assistance to organizations or individuals in the U.S. So if you're an organization giving assistance to other domestic organizations or individuals, you'll need to track the information for Schedule I. One thing to note is Schedule I is not required for 990 easy filers, but there may be some information that's used to complete the schedule that would be required to be disclosed on Schedule O. So there are 3 parts. Part 1 summarizes the key policies such as how grants are substantiated, how eligibility is determined for the grants, and how monitoring is done on the grants made. Part 2 is organizations, as where you list organization and governments that receive more than $5,000 each from your organization. So if we pull up the form. So Schedule I here is Part 2. So this is where you would list the name and address of the organization, their EIN, the amount of the cash grant, or if there was, if it was a non-cash contribution, you describe that here and the amount, and then also the purpose of the grant. So this is listed by organization or by government if they received more than $5,000 from your organization. Part 3 is for grants and other assistance to domestic individuals. So differently from Part 2 is here you only list the types of grants or assistance. So you're not listing by individual person. So that could be something like scholarships, awards, other things like that. So you would include the type of grant, the number of recipients, the total amount of cash or non-cash assistance, the method used to determine the value, and the description of the cash assistance.
Yeah,
So that is,
go ahead.
oh, I was going to say that's Schedule I, and if your organization is providing grants or other assistance to foreign organizations or individuals, that's reported on a separate schedule, Schedule F. We won't be going over that today because it's not as common, but the information is fairly similar.
I was just going to add in for both I and F, you're allowed to make these kinds of grants and distributions. The IRS just wants to know about it. Normally a nonprofit's can spend money internally, spend money on programs. They normally don't give money to another entity. Some people do. You're allowed to do that, but they just want you to report to them if it's over a certain amount. That what you did is reasonable versus I'm distributing to some charity somewhere else and there's not a good reason for it. They just want you to disclose that you're doing it. They want to ask you about it, they can. Go ahead.
Great, so I will be passing it over to Fritz to discuss Schedule L.
Okay, and then if you don't mind, if you pull up the form.
Yes, of course.
So Schedule L, again, a lot of these forms are, yes, you're allowed to do it, you just need to tell people about it. I'm going to skip part 1, that's very, very rare that would come up. But part 2, if you're going to make loans to people, which I would probably advise you to not do that, but if you're going to make loans to related people, you need to disclose it. So it says loans to and or from interested persons would normally be a board member, some sort of related party. There's definitions in it to define that. But if you're going to do that, they just want you to disclose it because, of course, they want to make sure that there's a reasonable reason why you're doing this. So that's part 2. If you meet the definition for you have this type of person and you have this type of transaction, you disclose it. Similar to part 3, if I have grants or assistance to an interested person, I have to disclose it. This was kind of obvious why they wanted it. If you're going to make grants to a related person, they of course want to know about it. One of the things that comes up a lot on part 3 is if you have a scholarship committee, they want to make sure if you're giving money to somebody that's on the committee, some family member that's on the committee, you're going to disclose it. So both those two, if you meet the definition, you just need to tell people about it. If you flip the page, the one that comes up often enough is, I'm doing transactions with board members or interested persons. There's nothing wrong with that. If it's a fair transaction, you just have to disclose it. So we'll see this a lot on our nonprofits where maybe there's a loan, maybe you're buying some services from them. All that's fine. It just has to be disclosed. So a lot of people ask us, well, am I allowed to do this? You're allowed to do it if it's reasonable. You just have to disclose it. So if people want to check into it, they can. And again, the instructions, if you want to know on these different parts what an interested person is, you can read about it. There's a lot of different types. The main part is if you're an officer or a board member or you're on the schedule of key people, it applies there. If you're making scholarships, if you're on that committee, that those types of people. If you own, if there's a related company to a board member, that potentially would be included here. But you can read those definitions about what applies. I think the takeaway is always, do I have these types of transactions? Is it over the amount and then I need to report it? Right, and I think if you go back to your slide there, if we really quick, if you go to the next one, there's the dollar amount. So there's a lot of times where you might even have a transaction, but it doesn't have to be reported. We see this often where they aggregate, it's over 100,000, I have to report it. Do I have a single transaction that's over 10,000, I have to report it. But we'll see things where it's $5,000, $1,000, etc. They don't have to report it. And then again, that 1% of revenue, obviously, it doesn't come up very often either. So, and all these forms we're going over, if you're interested, these instructions give a lot more details on each one of the forms. So I think that's it for Schedule L. If you don't mind, we're going to just go back to the form for Schedule M. I always like to look at the forms. So Schedule M, if you're going to receive in-kind gifts, you need to report them if they're over $25,000 per year. And if you look at those line items, there's a lot of people that we know that get these gifts. There's a lot of nonprofits that don't. But if you look at like line 4, if you're one of those people that sells donated books, you sell donated clothes, donated cars. We don't see a lot of donated boats and planes. If you get donated securities, they're on line 9. If you get donated land and buildings on line 15, line 16, line 19, if you get donated food, some of you are healthcare, line 20, donated medical supplies. The takeaway is if you're getting more than $25,000 of in-kind gifts, you need to report what it's for, and you can see you're estimating how many items I got, what's the amount by line item, and you report it. If you're doing an audit, you're likely tracking this anyway if it's material, because you're going to want to be recording financial statements. But the IRS just want you to tell people, okay, I got in-kind gifts. They're under my donations, under my revenue, but I need to also tell people what was the in-kind gift. Again, the most popular, probably for everybody, is line 9, where people get donated stock. But there's a lot of you that have thrift stores, or you're a food, you're in the, you're one of the nonprofit food nonprofits. We see that a lot. Again, a couple of healthcare entities we know that they get a lot of donated health supplies. But these are all these line items. If you go down a couple lines there, there's a few people that go into the other. For people that do the fundraising events where they get donated items for their auctions, that usually that's where it's listed under line 25 and 26, so they don't really go up above. So I think the takeaway is that track these things if it's over 25,000, so you can report it both in your financials and on tax return, and report it on here. Schedule F.
Here we have a good question in the question box. So somebody asked, if we are purchasing food that is given away to individuals as assistance, does that count as assistance that has to be reported on one of these schedules?
And then Karen, you can tell me if I'm wrong, but I don't think if you're purchasing food and you're giving it away, it goes on here. You potentially have that back there on, I think it was Schedule I. You potentially might have on one of the other schedules. If you're giving more than $5,000 away to entities or individuals, potentially that would have to get.
Yeah, I think I would agree that if you're giving, whether it be cash or if you're giving food or other types of things to individuals, that should be reported on Schedule I, Part 3, which is assistance to individuals. And as mentioned, you don't have to list every individual. That's an aggregate. You're just saying how many people received assistance and what the total value is.
Right. The one thing we had come up a lot, which I guess was more cash during COVID. A lot of you had those big, huge COVID grants where you passed money on to people and they were over this threshold. So you had these huge lists of, and this was cash, that you were giving out to people, and you had to report that. We also see the scholarships quite often with the foundations where that goes above the amount. You have to disclose that. But if you were buying food, it wouldn't go on Schedule M, but it might just need to be somewhere else depending on if you're over some thresholds. Okay. All right. So one more form. So Schedule R. Again, some of you do a lot of this. Some of you do none of this. If you have related organizations, you have to be reporting A, that they exist, and B, if you have significant transactions. So Edwina, one more time, if you don't mind going to the form. We have a lot of friends in the housing world that build apartment buildings, etc. They have a lot of these organizations. So first one, if you have a single member LLC, so you're a nonprofit, wanted to own something and put it in a single member LLC, that's disregarded for tax purposes. It's not a separate taxable entity, but you have to disclose it here. So if you think about if you have any single member LLCs, they go on Part 1. If you have a related tax organization that you control, and I'll go briefly into that, that needs to be listed here. So for example, if you set up a nonprofit, you control the board, you're the one that appoints the board, etc. You meet this control definition, which you can read about later. You would need to disclose that, yes, I have a related tax-exempt organization, and you just list it here. So for example, the people that have HUD projects, the HUD project's a separate project, but they control it, so you're reporting this is out there, and you're just telling the IRS about it. So that's Part 2. I want to flip the page there. The people that have the partnerships, so the low-income housing tax credit people, so you have these partnerships, you have to disclose that yes, I'm the general partner in all these partnerships. You can list them there. There's people on Part 4 that have set up taxable corporations or trusts. So we see a few of those. Again, you just have to list them. So you can see these 4 categories are, if I have any of these entities, I just have to say they exist and what they are and answer those boxes there. That's the first part of the schedule. And if you want to go see. So going back to the slides, this is, you can go flip past that slide. And we talked about that. Next slide there. This is a picture, and we actually have some nonprofits that have every single one of these on here. I know a lot of you don't have any of these, but this is just a picture of whatever these organizations are. You need to disclose it. You can flip the page. And then here's so we talked about the entity. I got to disclose it. If I have transactions, I have to disclose it. So it talks about all transactions for interest, annuities, royalties, rent from any of these entities. I have to disclose anything else that's over $50,000 in aggregate by transaction type. I have to disclose it. So you could have transactions that fall below this. They don't get disclosed even if the entity is disclosed. We have a lot of people where they'll disclose it. Yeah, I have. For example, this partnership paid me a fee, $100,000. I have to disclose that. The main part of this form is that do you have these types of entities? And if you do you have transactions that have to be reported? That's the takeaway from Schedule R. I guess on that one, Edwina or Carrie, you guys want to add anything to that? Is that a good summary?
I think it's fine. We did have we had a question back on Schedule M. The question is, if it is your policy to immediately sell donated stock, is it still considered a non-cash donation reportable on Schedule M?
Yes, my opinion, if you get donated stock and you sell it immediately, it has to be a donated stock to you, otherwise it doesn't count for tax purposes. So if someone donates stock to you, you can, if you have already done this before, you have to have a brokerage account. They have to move the stock to you and then you sell it for it to count for them. So given that, they donated stock to you, therefore, it must be on Schedule N. So hopefully that kind of makes sense. If you need help on that particular thing, let us know. Also, your brokers can sit there and tell you how that whole thing works. But yes, I do believe it goes on Schedule N.
And to add to that, not only is it reportable on Schedule M if it's over $25,000, but it gets broken out on the face of the statement of revenue, and it still might be required to be put on Schedule B. So all of those components are still in place for the 990 reporting for donated stock. It is non-cash.
Yeah, really good question. And then again, if people call you and say, I want to do this, you can let us know, but what we're going to do is we're going to have you call your broker. If you don't have one, you have to have a broker where you set up an account, they move the stock into your account, and then you sell it. And to your point, the question, yes, I would probably argue you should sell immediately unless you're an investment person. Take the cash and then put it in your organization. Okay. Let's see. So I think that's it for Schedule R. And Edwina, if you want to go on to your section.
Perfect. So that is it for the Form 990 and schedules. There are some other schedules out there, but we just kind of went over the main ones. Next, we'll be talking about best practices for board review of the Form 990. So it is certainly a best practice to have the board review the Form 990. An organization that files a Form 990 must indicate whether it provides a complete copy of the return to all members of its governing body, and also include a description of the review process that's being done. So while it is not statutorily required by the IRS does believe that such review will improve tax compliance. So what things should board members key in on when doing their review? The first part to look over is Part 4 and Part 5, so the checklist of required schedules and IRS and tax compliance. For the checklist of required schedules, you'd want to review the answers for accuracy and understanding. Typically, any yes answers on the schedule will result in a requirement to complete an additional portion of the form or an additional schedules. And if there are yes answers for these types of questions, then you'd also want to review whether the proper schedule or section was completed as required. While reviewing the section, if the board member is unsure of what's being asked or the information, then they should request more information from the preparer of the form, or also review the IRS instructions, which have a glossary of clarification of the terms, and the 990 instructions are very thorough and very good and provide a lot of information of what's need to be required. The next section to review would be Part 6, Governance. It's possibly one of the most important areas for the board to review. So Section A includes information about the governing body and the management. So this would disclose the number of independent board members. An important note is to be considered independent, the board members can't be included in Schedule L or have a reportable transaction in Schedule L. So if there is a board member listed in Schedule L, then they would not be included in the total number of independent board members. Other information included here is just the disclosure of relationships between board members. So this would be either a family relationship or a business relationship. So that will be disclosed here. You'd also include any information regarding changes to governing documents. So if there was an amendment to bylaws or change in articles of incorporation, you would want to mark this section as yes and follow the instructions for whatever information also needs to be provided. Lastly, is there a process used to track the board meetings held and decisions made? So are there board minutes? And that would be disclosed as a yes or no if that's being done here. Section B is all about policy. So one of the questions is the Form 990 provided to all members of the governing board before it is filed? It must be provided to each board member in order to answer this as yes. You'll also describe the process used to review the Form 990. So the Form 990 doesn't necessarily need to be reviewed by the entire board. Your process can be, certain officers or a committee, and that would be described in Schedule O. You'd answer if there is a conflict of interest policy, document retention and destruction policy, as well as a process used to determine compensation for the executive director, CFO, or highly compensated individuals. So you would want to review these sections for accuracy, and we'll also talk about later why it's important to have these policies in place. The next sections to review would be the statement of revenue and the functional expenses. So doing a review of revenue sources, you'd want to see, does the revenue data suggest too much reliance on a source that could be jeopardized by a weak economy, declining stock market, et.cetera. So investment income, is there too much reliance on a handful of grantors and donors? Just reviewing what the revenue says about the organization. Next, for functional expenses, the allocation of expenses is key. So you'd want to review what are the ending ratios for total program, general, and admin compared to total expenses. As a general benchmark, you would want at least 75% of your expenses to be program and no more than 25% of total admin and fundraising. And then some supplemental schedules to review would be Schedule A, so reviewing the public charity status and the public support percentage. The public support percentage must be 33.33% for the organization to be considered a public support charity. And if comparing this amount year over year, if this is going down year over year, then you want to consider the activities of your organization, check in with your CPA, and come up with a plan for making sure that you continue to meet that public support test. Schedule C, which we didn't talk about earlier, but that is for political campaign and lobbying activities. So if your organization does any lobbying, if you're exempt under 501c3, do you have policies in place to prevent participation in a political campaign that could jeopardize your tax status? Has the organization filed a Form 5768 under election of 501H to make expenditures to influence legislation? If so, then Schedule C must be completed, and you'd want to be tracking lobbying expenditures compared to the allowable amount.
Yeah, I think, just tell me when you're done and we all just add something.
Okay. And then as applicable, you'd also want to review any other schedules that would be applicable to your organization and making sure those are accurate. Go ahead, Fritz.
I was just going to say, for most of you, and I assume most of you are C3s, there's activities that you're allowed to do here. You just have to disclose it. There's activities you're not allowed to do at all as a C3. You just be aware what those different rules are. And what am I not allowed to do? What am I allowed to do? And if I'm going to do it, I have to be reporting it, and I have to fall under some threshold that if I'm spending money in this area, I'm not going over the allowed amount, or versus I'm not allowed to do anything at all. Go ahead.
So next, Fritz will be going over unrelated business income.
We have a good question before we jump into unrelated business income about admin costs. So just if you have a couple comments about things that can be, sometimes that nonprofits include in admin that really might be program expenses, common misallocations.
I'll chime in, and then we would chime in too. I think one thing we get is executive directors, other employees that are actually spending time in program, they don't allocate their time over to program, they leave it over to admin, they leave it at fundraising. So that's one where there's things that actually should be allocated. I think client assistance, sometimes people maybe allocate, but really that's usually almost always a program expense. Interest on your the billing that you use only for your program, I think that's one that maybe sometimes people, they mistake and put on their admin, but it's really because it's interest, but then it's interest on their actual program building, not their admin building. But go ahead.
I would also add depreciation similarly to any like buildings that you'd use in your program.
Yeah. I think the main thing is, do you have expenses that are multi, over the 3 columns, and are you accidentally, because their nature sounds like admin or they sound like fundraising, are you not allocating it between the 3? And you probably should. If be careful you're doing that, you're not overdoing it. I think that's the main thing, is making sure that the programs are allocated over there where they belong. Do you want to add anything to that, Carrie?
No, you can cover it pretty well.
Okay, so unrelated business income, which you could have an entire class on this, we're just going to summarize it. So you're a nonprofit. One thing people worry about is that they think they're not allowed to have unrelated business income. You are. As a nonprofit, most of what you do is exempt. The income is exempt. It's not taxable. If you have unrelated business income, we're going to define that. That could be taxable. And if that income was over a certain percent, and I'm going to say 10%, that's not really defined, you could potentially have tax status issues if you had too much unrelated business income, gross income. But it doesn't mean you can't have it. So some people have determined over the last 20 or 30 years that they'd like to have this activity. It is taxable. But if you pictured, I make $10,000 on this activity and I pay a 30% tax somewhere, I still get to keep the 70%. So there's times where it makes sense to have an activity even if it is taxable, because me keeping the 70% is better than not having it at all. So going through this, do I have unrelated business income? And those 3 things are defined. So a big one here is this activity unrelated to my mission? So we work with quite a few nonprofits. They're very creative, and they do a lot of things inside their mission that have developed revenue. And so if you go and research this activity that you're starting, the question is it related to my exempt purpose? In a lot of cases, it is, or can I expand my exempt purpose so it is? So the first step is, if you're going to do an activity, talk about it ahead of time and research if it's related. If it's related, then you don't have an issue. If it's not, if it is unrelated, okay, that's step 1. Is it I have an unrelated activity? Okay, fine. Is it qualified as a trade or business? There's definitions for that. And is it regular carry on? There's definitions for that. I just want to flip the slide there. Just have a couple of slides here where we just kind of talk through that, hey, the first one, You know, is it unrelated to my exempt purpose? What is a qualified trade or business? What's regular carrying on? That number 3 below, that you could have something where you don't do it very often, so they probably wouldn't count it as unrelated business income. So the key is whatever this activity is, can you get out of it being unrelated? Is it actually related? If you want to flip the slide there.
Oops.
Sorry, go ahead.
There you go, sorry. Clicked too much.
This comes up quite a bit. Some of you might not know bullet point 1 there, advertising income. Advertising income is always unrelated business income. There is no exception. So if you're doing advertising in your nonprofit, it's a newsletter, you're letting someone advertise these various things, that is always unrelated business income, have to go calculated. But what's excluded, which people run into, is if people are sponsoring your auction, they're sponsoring your nonprofit, your golf tournament, if you follow the rules, and there's a circular on what a qualified sponsorship is, if you follow the rules, someone giving you money to recognize them may not be advertising income. You want to check on that. But if you're advertising the gross revenue, and then you go through this calculation to see if you actually made money on it, you would pay tax on the net. That is a key to all these calculations. Is let's just say you've decided that I do have an unrelated issue. Now I'm going to calculate if I made money on it. And then the IRS law defines how you calculate it, but you only pay tax if you actually made money on it. Most of the time, advertising when people made money on it. The second one, whole other class on rent income, usually exempt, but rent income on debt finance property, the net income is taxable. And then there are certain types of selling certain types of things that may be taxable. So those are common, the common 3. That number 1 we see often in the housing world. Somebody will see number 2. So there's some common ones. I'm going to flip the page. The opposite is there's a lot of things people may not know that are exempt. So for most people, interest in dividends is not it's exempt. It's not taxable. They put a thrift store exemption in here, I don't know, 30, 40, 50 years ago. So sale of donated goods are not taxable. This is a royalties for, if there's any alumni associations on the call, people that have these Visa cards with their names on it, royalties are not taxable. And then if the activity is performed by 85% more by volunteers, that's not taxable. But there's all these things here where it's exempt, so it doesn't matter if I make money or if I have income from it, it's not going to be taxable. So that's good to know. Go ahead and flip the page. One key here from a law change from a couple of years ago, both these are. You can no longer net different activities. It used to be you'd have activity 1, made money, activity 2, lost money, you could net them, didn't have to pay tax. The IRS got smart to that. You can't do that anymore. You have to report your issues separately, and if one of them made money, net income, you would pay tax. One of the negatives from the corporate tax law change a few years ago is you now pay 21%. In the old days, maybe you pay 15, maybe you pay 10, maybe you pay 25%. It was graduated, but it's 21%. So if you have taxable income, you're going to pay 20%, and this is federal. You also probably going to pay state. So that's just I guess that's just a really quick summary of unrelated. I guess any questions on that subject?
No new questions right now.
Okay, I think the takeaway for everybody is we tell all of our clients, we have a lot of creative clients. If you please talk to us ahead of time before you do it, so we can determine if it's an issue, or call us after you get it and let's research if we get you out of it. You know, if it could be related before we start filing your tax return. But the main thing is to know ahead of time if you're going to have an issue before you do it, or of course before you file the return. For anybody that has this, it's called a 990T. It's a separate tax return. You file it, you pay your taxes. One takeaway is if you're doing this, that you would pay estimates like you would as a normal business, which also trips people up. Is that they find out later that they owe money, they didn't pay any estimates, now they have penalties on it. So one of the things for people that are doing this is make sure your quarterly estimates set up as if you were a corporation, so there's no penalties on whatever tax you might have. So, Lynn, moving on to your.
Awesome. So the last section that we'll be talking about is the Form 990 as a marketing tool. So as a reminder, the 990 is a public document. So while you want to view the form from the compliance perspective, it's also good to view it from a marketing perspective, because this will be looked at potentially by potential donors. So there are different components of the Form 990 that paint a picture of your organization. So that's the governance and policies, functional expenses, and your program achievement statement. So for governance and policies, the ones that we mentioned before, what is the review process for the 990? Do you have a whistleblower policy, document destruction and retention policy? Those things tell a story about how your organization is being governed. For functional expenses, as we mentioned, how much are your expenses being allocated to programs versus management and administration and fundraising. And then lastly, your program achievement statement. So what's the story that your 990 is telling? For your program achievement statements, this is an opportunity to describe what your organization is doing and what they are contributing back to the community. So if we take a peek at the form, on the second page of the 990 is where you would describe your organization's missions, and then the top 3 program service accomplishments of your organization. And going back to the slides, here's an example of program service accomplishments. So for the program service accomplishments, you want to use this as an opportunity to describe what your organization is doing. You'd want to include quantifiable data when possible, why your organization is providing this, and then also geographical information. So here's an example of a good program service accomplished statement. Books for All provides books to school and children. So very general, doesn't give a lot of detail. The next one is a better example. Books for All provides books to school and children across Clackamas County. So all children have access to books. So this adds geographical information, and then also the why. Finally, here is the best example. Books for All believe all children should have access to books to improve reading skills and make reading a part of their life. During 2019, Books for All provided 100,000 books to schools and children across Clackamas County. So this includes the why, quantifiable data, geographical data, and also information specifically for the year that the Form 990. While you want to include as much detail as possible, you also want to be concise. Looking back at the Form 990, you have this section to describe your different program service accomplishments, but then anything after what fits here would be pushed towards the back on Schedule O. So it's really helpful to kind of have just all of that information in one place for the reader to have all that information on one page, rather than having to go to the back of the Form 990 to continue reading. The next piece that we want to cover is Charity Navigator, which is one of the largest and most relied upon evaluators of charities. So Charity Navigator will assign scores to nonprofit organizations, and these scores are partially driven by information from the Form 990. There are 2 sections. There is financial health and accountability and transparency. So for financial health, all the information used to determine the financial health is extracted from the Form 990. And these financial efficiency performance metrics are based on the expense allocations on the schedule of functional expenses. So the program expense percentage, the admin percentage, and fundraising expense percentage. As we mentioned multiple times, this stresses the importance of reviewing the allocation of costs on the statement of functional expenses, because this is what's going to be driving your financial health score on Charity Navigator. The second section is accountability and transparency. So 12 of the 17 items are from the IRS Form 990, and the rest are from the organization's website. So on the following 2 slides, we have what those 12 items are from the Form 990 that contribute to the accountability and transparency section. So first, does the organization have an independent board? They usually want to see that the voting majority is independent and that the board has at least 5 members. Is there material division of assets with or without satisfactory explanation? This will actually detract from the score. Does your organization have an independent financial statement audit, and is it overseen by committee? Does the organization have any loans to or from interested parties? And this is another part that would detract from the score. Is the organization documenting the board minutes? Is the Form 990 distributed to the governing body before it's filed? Is there a conflict of interest policy, a whistleblower policy, record retention and destruction policy, a policy for determining and reporting CEO compensation, and then board member compensation. So it's important to understand what goes into these ratings so you can do what you can to maximize these ratings. If you look at these sections that are included in SCORE, if you don't have some of these policies or procedures in place, you could consider adding them to improve your organization's score. And all this information is published on Charity Navigator's website, so you can see what goes into the score and what score your nonprofit organization has.
All right. Well, that concludes today's presentation. In closing, I'd like to thank all of our attendees who joined us today and submit some great questions. Also, please don't hesitate to reach out if you had a question that we didn't have time to address during the chat today. Again, I'm Aaron Sachs, a leader of our nonprofit team, and you can reach me at the number and email on this slide. Thank you for your time and have a great weekend, everyone.